Brian Wilson is our market strategist. So those of you who don't know him, you
Yeah.
see him. You will read him in market desk notes all the time. So be Brian and Henry and I that share those duties. Because I run out of ideas after a day or two, and I've got to have somebody more competent pick up the baton. So they do that. So Brian's going to do the first half, and then I'll do
Yeah.
the second half today.
Well, it's good to share the load in terms of those notes. Secretly, sometimes I'm hoping that Tim gets the hard days. Perhaps perhaps I had one of those days today with today's market desk note. I've got three or four different things to talk about, and for some of our IBKR listeners, um, uh, we'll go into a couple of dynamics of what you'll see, on Edge itself. So I'll go ahead and start off. I'm going to give you a couple of examples. One is actually a bad trade from a couple of days ago. I'll go into a trade that worked out decently overnight. Then we'll look at a couple of other items. So let me go ahead and share my screen, and we'll kind of go from there. So I'll start with a bad trade. And it's not that the setup was bad, it's just that my timing was bad. So this is Viking Therapeutics, and I came into the trade right in here. Now, what I was tracking in terms of market structure was rising sentiment, which was great. I bought it when the shares were down during the day. That was also good. And you can see that short volumes were low. So in terms of uh, market structure dynamics, it was actually a pretty good trade. Sentiment had been rising, short volumes were moving lower. It's what we call divergence. Great setup. The problem was I bought it right into expirations. So yesterday was the first day of it was volatility expirations. Let me show you what this looks like on our calendar. So if you look at the broad market sentiment calendar, you'll see these green little squares here, and that designates when we're coming into expirations. And you can see right here, I bought it right ahead of Wednesday volatility expirations. I had been tracking a market that had been moving a little higher over time. And to be honest, perhaps I got a little complacent, or perhaps kind of lulled myself to sleep a little bit, thinking that that upside would continue. Of course, we got hammered yesterday. We talked about some of those reasons in today's market desk note. But you want to be very cognizant of expirations itself. We will mention it in the Edge notes. And let me give you an example of what we'll send to you. Every day we try to have three sections. We try to have broad market sentiment to tell you what's the setup look like right now. We'll also walk through the context of the market. That's very, very critical, especially when we're thinking about expirations, to know when that's coming. We'll give you a warning not only for today, but we'll look ahead for the next few days as well in that context section. But once again, I made a mistake. It happens once in a while. I'll try to learn from it, and I'll try not to be as complacent next time when we're coming into expirations. Did want to show you a trade that worked out better. And this is a portfolio that I have. It's just the triple Qs. And what I was looking at yesterday, and I'll show you how you can do this. I was looking for the actual intraday volatility, and you can do this with any portfolio. There's 103 companies in the triple Qs. You can go down and look at volatility one by one, or over here to the side, there's something called actions, and you can export that. So you can go ahead and export that to Excel. Once you pull that up, you can edit that information, and you can look at whatever info you want to, whether that's demand. In this case, I was looking for that volatility number. And what I was trying to figure out was, what was the, exact volatility for that. And it was coming in right at about 2.3%. Well, that was actually the NASDAQ hovered around being down about 2.3% for most of the latter part of the day yesterday. Tim and I actually made an identical trade. We didn't talk about it, but we're aware of market dynamics. What I bought at the close was TQQQ. It's a leverage trade on the NASDAQ. I thought it would do better here after being down all of its volatility yesterday. That's indeed what happened. So wanted to show you two different things there. One was, how you can view the trends that are occurring on a given day to your advantage. In this case, yesterday it was weakness in the NASDAQ, and also how you can track things in your portfolio. In this case, you can export that info to Excel and track it accordingly. Have there been any questions coming in to address, or you guys have those so far?
Not yet, Brian.
Everybody is wrapped with your presentation.
Riveted. So I'll go ahead and continue. I have one other section, or actually two other sections. I mentioned the semis, the stocks in my morning note this morning. I wanted to give you an example of why I mentioned that. And I use the analogy of flying over your handlebars. You could use the analogy of being out too much in front of your skis. So look at what's happening here. 30 different companies in the stocks, and look at what was occurring here. So we were coming up, and obviously yesterday, the market saw tremendous downside. 9.2 was the overall sentiment score for 30 companies. That's flying out in front of your handlebars. That's getting in front of your skis. That's just a red hot sentiment number. Yesterday, at one point, the SOX was down over 8%. Well, very, very high sentiment coming into expirations. There's always the potential for profit taking. Well, we got that yesterday. We had some of the, accompanied bad news in the market as well. But you can see what happens with bad news when you get sentiment that is that hot. So that was the image I shared with today's note. Once again, very hot sentiment. Just be aware of it, especially when there's a lot of companies that are comprising that. One other portfolio that I wanted to share with you, and this is, I call it my top 15. And I take this from the SPY. You can do a download of the SPY, and I just drop it into this portfolio. And what I wanted to share with you is, I think part of the reason why the market and why tech started to roll over here during the last couple of days. Look at what's happened with short volumes. So note how low short volumes were for the top 15, a little bit of a short covering rally for some of those tech stocks. Note what was happening in the market at the same time. And then note what's happened when short volumes gotten way over trend. Well, we got the downside yesterday. Once again, always be aware of context in the market coming into expirations, very high short volumes at the same time for some of these leaders. And there's been a little bit of rotation out of some of those names. So with that, Tim, I do have kind of in a head section, but we can get to that a little bit later, and I'll stop sharing my screen.
Okay, thank you very much, Brian. Appreciate that. Let's see. I'll take a quick look at what we have here. So Martin, Teradyne hovering around the buy zone. Yeah, well, that's I'm going to address those, and then I've got three things that I'll cover. So we might have a little extra time for Steve Hicks to give us some real insights here at the end on the no pressure, Steve. Just kidding. We were talking about the Hicks rule just the other day. By the way, it was for those of you who are here for the first time, it was Steve, the longtime Edge user, who first observed statistically that stocks that hit 10 and have day over day declines in supply tend to perform well, but they almost always will produce a short-term gain. And we've incorporated that into some of the analytics that we do to create the daily trading ideas portfolio, by the way. So I'm going to share my desktop and come, Martin, to your point, and Brian, you talked about the SOX. I have just a semiconductor portfolio. And by the way, if you haven't used Edge, you can do this. So here's what it's really easy to do. You up here, you can go create a portfolio, and you could do a static portfolio and just, it's a little bit tedious, but you can put in tickers. I did that the other day with the Dow 30. I just was, curious. Didn't take long at all. Dynamic portfolios, you're going to use criteria. Like you could say, I want market cap to be equal to small cap, and that'll give you basically the Russell 2000. So you can see what's occurring. But going down to this semiconductor portfolio, Martin, there are two things that would be cautionary notes. Number one is not to beat the dead horse to death, but I was going to talk about that too. Context affects probabilities. And the reason, as I explained I think I touched on this at the Interactive Brokers demo, you can have supply and demand, and 20% of that input into the demand calculation is derivatives, baskets of options generally now. Single stock futures aren't, used much, if at all. I don't know. But do people roll them? Do they let them go? Do they pay up? Are they cheaper? All those things have an effect on the demand calculation, and part of it can just vanish. That's derivatives are a right but not an obligation. If you own an equity, if you buy or sell an equity, well, that's an action, and it's an immediate input. Well, the stuff that hasn't happened can be a real problem when it comes time for those to renew. So my problem with this, and my cautionary note on Teradyne, is demand has peaked and is falling in the semiconductors. The supply side's falling too, but that does not work out well. Mathematically, we have found, I don't have the statistics on it, but in our we run market expectation models for public companies. I give you a great case in point. Alcoa, ticker AA. We could look at that in a model and say, wow, that's going to get clocked. And it has falling supply, but weak demand, falling supply, when information is introduced to the market, can be very bad. I mean, it doesn't matter that there's low supply if there's no demand. It will still tip over. And so my problem here with Teradyne, and my cautionary note, Martin, would be we should get out of options expirations first. I mean, you just never know. Plus, aren't they may be, I don't know, maybe if they're equipment company, semiconductor equipment company, they may be off cycle like Applied Materials. I don't know the answer to that. You might. So I would be wary, and I'm always cautious during options expirations. And let me make that point number one: context matters. For those of you who are new and here for the first time, you will hear us say over and over that the core elements of market structure as a good quantitative technique for improving your probabilities is that you always think about broad market sentiment. You always think about context, and I'm going to go over here. It'll navigate me away, but I want to show you this to the website. And then under resources, you can go look at the expirations calendar. And this should always, be wary around these things. Here's July. They're all lined up right in a row. And sometimes that's, means that if there's going to be an impact, it can be pretty severe. And, what happened? Well, on the 16th, really, the series expires at the close on the 16th, and a new series of VIX and all of volatility as an asset class launched on the 17th. And what happened to the Dow? Shot up 740 points. Well, that can be nothing more than the renewal of a hedge against volatility. That's going to be low volatility stocks. I just talked to our financial advisors about, we've used double line portfolios to dampen volatility, principally in fixed income, but in other things too. And big institutional investors do this. BlackRock just bought an outfit called Preqin and combined it with their own Aladdin risk management system. That you put those two together, I mean, it could be $20 trillion worth of assets that are using risk management strategies such as low volatility. Well, if those things renew and people have an expectation that there could be some volatility, that's how you get the Dow going up 740 points, because that basket reflects a low volatility trade. And then it's over. Then it's done. And then the Dow goes down 500 points because it is not indicative of an economic trend or a trend at all. It is a one-time event, and it will last till the 20th of August. Then it could change, right? So you have to be aware of those things, and you could portage around those. If you just don't want to take any chance, take your money out before you get there, maybe on the 16th with that big divergence, and then wait. New options trade on the 22nd. And Brian, we should add that, I think. I really think we should add the 22nd, 23rd. And you don't want to block out the entire calendar, and maybe we dampen, now that we're T+1 settlement, this we call this month-end window dressing. It's for public companies to know. If you got bad news, by the way, if you have a public company, we'll tell them, put it out in the last 3 days of the month if you can control it, if it's non-material. Or if it's material and it arrives then, that's when you should do it. Why? Because BlackRock, Vanguard, State Street et al., the passive complexes rebalance. And it just washes all that stuff out. And then the next month, new money, people are putting money to work in their 401ks, et cetera. And you can ride out some bad stuff that way. It's, just a little thing that we teach public companies to do. So you just have to be careful there. I traded VKTX2. I had a stop and a limit, and that's my next thing I'm going to talk about, an epiphany that I had. And I shared this already with you folks who attended the Interactive Broker session. So I bought it, and it was stopped out fairly quickly from VKTX. I think it was on Tuesday. And then the other stuff did fine. You're going to get stopped out. Statistically, what we tell folks is that you want to use high probability trades with generally stops and limits. I don't always do that. You have stops and limits. There are liquidity seeking algorithms that are going to try to find those. It's the way that the market works. So there's some risk that those things could be triggered. You just want to stack the deck in your favor. And it works very well. There's just a key component to know. So WMB, great low volatility trade that benefited from the fact that there was demand for low volatility. You saw that in energy. Tends to, in this market, that's gonna happen. Going back to the desktop here, that dashboard. Here's what struck me, and you folks who've attended a long time, John Cook, Steve Hicks, Barry Bailey, the veterans, you guys, Barry Norton. I don't know if Barry's here today. We have talked about stops and limits, and here's how that works for everybody who is new. Let's use daily trading ideas as an example, and Legend Biotech, which it was great. Worked great. I forget when I bought it, because when I trade a lot of stuff, and then I don't do stuff when it's not wise to do it. But
hey, Tim, can I interrupt you for 1 second, Tim? One of the questions was showing a full cycle. How to decide on when to buy and sell, using the entry and exit criteria.
Okay, so here's a great example, and you let the market do that for you. What we say is your time frame as an active trader. There are different things that one can do. Doesn't mean this is the only thing. It is a core use of the edge data is 1 to 5 days. Why would it be 1 to 5 days? Why wouldn't it be 7 to 10? Well, we have been studying the patterns of institutional movement for a very long time. I mean, the next year will be 20 years since I founded Modern IR, and Brian's been there, coming up on 10 years. It's a long time. So we look at these patterns of movement, and they very consistently run 5 days. If you're moving money into and out of the market, it's very difficult to get it in. If it's big institutional money, you can't just go, here's my $5 billion, move it today. Doesn't work that way. You'll destabilize, you'll wipe out all your returns. So it takes time. And so we see those patterns, and it's those patterns of supply-demand imbalances that create the opportunity to produce returns. So here's exactly what one would do. And it's what I did with Legend the other day. So here's the preceding closing price. This probability simply means that in the trailing 90 days, why not 100, why not 5 years? Because everything changes. The market is not what it was 180 days ago or 5 years ago. Every quarter, things change. Indexes rebalance. People change their asset allocation plans. I do it. I have a discussion and say, what do we want to do with this? Well, I think we're going to shift to short-term laddered fixed income because we think A, B, and C will happen. And if not, we're hedged anyway. So that's what everybody's doing, right? So we're taking an opportunity to trade around that. So the 100% probability merely means that when these same conditions existed historically in the 90 days, how often did those produce returns of 2%? In a 1 to 5 day window? Well, did every single time. Now it depends, there's a lot of volatility in there, and you have to beware of that volatility risk. If you go back to the table, just hit that button, you could say, Legend moves in the last 5 days had an average of 8.2% volatility. That also changes. So what would want to do, I think I bought this, it was probably a day earlier, but I put my entry point just off of the low, and I put a pre-market limit order in. And it didn't, there was some time passed, and that because early in the day, high frequency traders are going to distort prices. They're thinking about where's the reference price. They're not thinking, it's machines. They're sifting all the data and saying, where's the reference price going to be into the close? Going to be higher, going to be lower? Well, they're going to suss out and trip orders. So sometimes you can, if everything's going one direction, the broad market sentiment is up, there's no options expiring, all the supply demand trends look great, I might just buy right off the bat. If not, then I want the market to come to me. So I put in this order, and the price sure enough came around to me. I remember it was like 54.89. And so my order filled, and here's the epiphany. Where should your stop be? I'll tell you. So then I just put in a limit, and it limited out sometime later that day. I was only in that position a portion of the day, but it might be several days. Rarely do I run a full 5 days. Usually it's 2 or 3, 1 or 2. I really like to buy later in the day and then sell the next day if the supply demand equation is right, because late in the day, that tells us where the passive money is, the reference price. Now, indexes need a benchmark. They're not trying to beat something, they're trying to be it. They need the price to be very close to the midpoint. 90% of trades are derivations of midpoint. That's why how prices behave relative to midpoint is an important input into our models. And so that's what you can do. So here's what I realized the other day. I was discussing this internally, and I was going, because I'm getting stopped out more in the last couple of weeks than what I would prefer. I don't lose money, but then I've lost it. I went back and looked at my trades in the last 2 weeks, and had I set a wider stop, all of those would have delivered returns. Instead, I was stopped out of half of them. And I said, what is the issue? What do we know to be true? Demand supply, fully vetted. We have a lot of math. We beat the crap out of the math. We've got somebody internally who does that as a full-time job. So I know that's correct. I know the context. I know the effects of that. We know the effects of exogenous events like Jay Powell speaking, earnings seasons. The only thing that was not vetted statistically is the stop and limit. Because we'll say, all right, if you can buy it down half its volatility. So if it's 8% and it comes down 4%, and then I put a stop down of another percent, you would say, well, that's pretty safe. Yeah, but is that statistically relevant? Is it valid? And frankly, it's not. And I mentioned this on the Interactive Brokers webinar. What is the average of 1, 2, 3? We use the 1, 2, 3 rule. SPY, the ETFs, and it's a general rule. You can look at what an ETF will move, like I think SOX, maybe it was triple Q. Brian, you'll have the answer to that. What was it down? All of its volatility. That group, that 2.7%, it would do all of its volatility. Therefore, the next day you will have a short-term chance. And I did the same trade as Brian. I put in TQQQ, twice as much as my hedge SQQQ, and I dumped them both at the open. I don't really care. Made my return exactly as expected. But I'm not going to risk anything else. During options expirations, I have no idea what it's going to do the rest of the day, and I'm not going to chance that. I knew that trade was going to work, because The machines are going to move something. Will it move back toward the average? No, there was no demand. So it tailed off again. But that's what happens. So here is the epiphany. The average of 1, 2, and 3 is 2%. We track this all the time. The movement of the S&P 500 basket is 2%. So that is in essence the risk. The risk that one has to be willing to take in the market is 2%. Hedge funds, by the way, it's 5%. I had the guy was number 3 at Millennium Partners, huge hedge fund, tell me, if you're down 5%, we seize your portfolio and dump it, because they all run in pods. They're like, 70 different internal teams that compete with each other, and they all run individual money for the firm. They kind of compete with each other. Well, at 5%, you're dumped. So, that's a lot of risk to me. I want to take 5% risk. But I realized 1% is insufficient. As of random, there's way more volatility just in the core of the market, the S&P 500, than that. So the stop has to be 2. I found no statistical. We've not done enough for me to assert this, but I did my own statistical analysis and I handed it off to the team internally, and I found no difference between 2.5% and 3%. No statistical difference. So if you put us, that kind of encompasses the move. So if you can calculate it. Here's what I do. I have this little spreadsheet, right? So if I have a momentum stock and the price of that stock is 55, where am I gonna put the stop? If I bought it at 55, well, my stop's going to be about 53.63, 2.5% down, and 56 is up. I only have to rise $1, right? But for me, that's a 2% return. And that's within what Citadel et al. Are going to allow me. The reason it works is because I know there's a supply-demand imbalance. If it's low volatility, I'm going to cut that a little bit. So let's say it's, whatever. It's Alcoa at 32.31. All right, so I buy it at 31.83. I'm aiming to exit at 32.96. You could let it run if there's not something else happening. But it's the way to think about what the machines will give you. Remember, the market is priced by machines. Citadel takes no chances. They just want 1/10 of a penny. The whole basket is going to move 2% because it's the nature of the market. The ETFs that track them, about 1%. Momentum stocks that color outside the lines, 3% or more. Okay, well, let's just take our piece of that. This is one piece of an overall approach to, the equity market, but it is a very effective way. Just realize that context matters. So summarizing, stop should be 2 to 3%. Would be willing to take 2% risk. And I did that with VKTX, All right, so I'm stopped out 2% down. I don't care because the other positions I have more than offset that. Sometimes that's the way it's going to be. Over time, we find that the return, if you averaged it doing this over a year, you could average, if you got everything right, and we're not gonna, close to 1.2% a day. And you would be able to trade, call it 87% of the days. Now, I don't do that. But I think that's helpful to know. So let's see. The last thing I want to show you, and I will shut up, is the usefulness of looking at your dashboard to understand big trends. And again, if you don't like what I just went through and say, well, I don't know if I want to do all that, you could do this instead. When should you be in and out of a communication services ETF, let's just say? I could come over here and zoom in on communication services and say, well, if this trend continues out the other side, I mean, it's getting kind of beat up right now. If out of options expirations, call it Wednesday next week, these conditions continue to exist, I'll be a little surprised. Then you'd go long communication services just by the ETF or a leveraged version. Why? Because demand and supply are diverging. The only reason prices aren't performing right now is because of options expirations, context. And of course, there'll be earnings. But you could apply this to anything. You could do an AI portfolio, which looks very good, except the supply side is tracking the rise in demand. Well, that will neutralize the rise in demand. Gold, you could do it with gold. Just build a portfolio of, I've only got 4 stocks in there. Is that a great proxy? Not great, but it certainly does reflect reality. Gold took off at June expirations with strong demand and falling supply. those conditions have moderated, but it's still pretty good. I'd look at that and say, boy, if the supply side doesn't continue, stops rising, wow, there's still a lot of opportunity in gold. Well, you can just use that. I mean, it's a great way to have something that really reflects what all of the money does and thinks as a way to attack a piece of the market. I'll finish down here with small caps, which I highlighted at the Interactive Brokers webinar. But if you want to know why small caps have performed very, very well, there you can see it, right? Again, basically, when the Russell rebalance is finished right here, demand rose. Supply rose too, because that's how orders are filled. Then it plunges, and that's what gave us the price rise. We got a 12% run in RUT, and you will know when you should get out of it. It's as soon as this peaks and this rises, it's over. It'll give you a little advance warning that other people who aren't looking at that are not going to have. So that's to me, a very useful thing that you can do with supply demand everywhere. And why do we do 30 days? These are all 30-day views, because it is a good general read. It's just a central tendency. You could look at any period, but if you're thinking about moving some money over days, this is a pretty good way to do it. Okay, I think that is all I've got. We can talk about what's ahead, if you like, but we can also just answer questions.
Tim, quick question from Joe on here. So in that LEGN example, 8.2% volatility, you're gonna still, something with 8% volatility is pretty high. Do you adjust? The entry and exit is gonna reflect that volatility.
Yeah.
Do you change that stop on something that has 8% volatility? You say, yeah, I'll do this. I'd take 4% volatility on an 8% on that sort of move if the data is in my favor and we're not in this sort of environment. How will you adjust depending on greater volatility for stop loss, or is it just a central rule?
Right. It's not an exact price. It's a range. Right. It's very much like, what a marketable limit order is. A marketable limit order says there's a bid and an offer. Bid's always going to be lower than the offer. And there's some kind of spread in there. Could be a penny, could be 20 cents, right? So if I really want my trade to be filled, I have to put my limit order inside those brackets, and I get to determine, am I going to be closer to the bid or closer to the offer? Well, it depends on how much I wanted to get it filled, right? If I wanted to get it filled, I'm going to set it closer to the offer. And I do the very same thing with those ranges. If I really want to get it filled, I'm going to go back and look at that range and say, I'm setting it just past the midpoint of the range, and I'll take that. Now, what's the risk for me? I have to put my stop a little lower, right? So my stop, and so if I'm going to put a stop in and I take the midpoint of that entry range, now my stop's 2.5% instead of 2. If it came down 4%, I don't have to have the lowest stop, because what's the probability a machine moves at the full 8%? Very, very rare. It's happening now in the market. It is extremely rare for parts of the market to move the full length of its volatility. Also tells you, I'm concerned about that. These are the kind of things that happen when the market breaks down. I'm not saying it's going to happen, but these are very much the conditions that to me should be cautionary. It is extremely rare. So be warned. I don't care what the data say at present. These are concerning conditions, and I'm going to be very careful to see how we come out of new options, Counterparty Tuesday, when all the banks, somebody's getting killed in this. I mean, whoever had to fill that Dow order, and it caused the Dow to go up 740 points, they lost a crap ton of money. So that means they're going to have to sell something. And it generally comes after options renew, which will be on Monday. So Wednesday, we're going to get, if Wednesday, all of a sudden the bottom drops out of the market, you will know why. I am not predicting that's going to happen. I just take the data as it comes each day. But these are clearly things one should know. Anyway, that's my answer. If you want to fill it, stack it a little higher in that range. But same point on the outside. If I might shorten my return as a result, like instead of taking the upper end of the range, I'll just take the 1.7% instead of 2. I'm happy with that. I mean, look, if you can make 1% in a day, it's really good, right? That's that's really nice. And then you come back and you do it the next day. I traded for 1 second today and I made 35 basis points and I didn't look back. I don't care what else happens. I will wait now for the next opportunity. And I think that that's a really prudent way to approach it. Yeah. All right, Steve, you're laughing over there. What do you got?
I'm laughing because I bought short Tesla at 256 today.
Did you?
I'm going to party.
Well, good for you. That's a good use. Good use of, I mean, there's so many opportunities to use the supply demand imbalances and what you know is occurring. Yeah. Good stuff. Yep.
That puts a smile on the face.
Indeed.
Yeah.
That's a champagne day.
Yeah.
Anything else? Did I fail to answer a question? And no, please ask. This group, we've been doing this a long time, and it's, we're a candid group, and we're open, honest, and communicative. So if you have, feel free to ask anything.
Tim, one question for you with the stop losses. I noticed there was a difference between the momentum and low volatility.
Yeah.
2.5 versus 1.5. Is that a hard fast rule, or does it just depend on a given stock?
We have not vetted that data. I want to vet that before we know. And so, I call him young Nate, the mathematician. Brian and I, in fact, Nate, Brian, and I just had lunch yesterday. Was that yesterday?
Yesterday. Yeah.
So, So, but that's Nate's job. We want to take a large data set and get statistical viability in those stops and losses. I built the model. I built it and I said, here's what we want to test. And I handed it off to Nate because he can now automate that stuff. So I want to confirm it. Just keep in mind that really, the core here, and then we will wrap this affair up. So we're respectful of your time. Is this, that if you look at those two portfolios, by the way, we have the momentum and low volatility without probabilities. So then daily trading ideas is calculated probabilities. Could we do that with everything? Yeah, but it takes, where's the reliability? My point is this: if you go into the momentum portfolio, you could dump this in Excel and see the average volatility, but you can run an average. We want 3% or more. And so if the broad market moves 2%, these things are going to color well outside the line. Now look at the low volatility portfolio. And there's your average volatility. If you take the average volatility, it's of course going to change with time, but in this low volatility portfolio, I can eye it and tell you that it's 1.7%. So, if I have a 2%, 1.5 to 2% stop, clearly I'm giving myself a lot of rain and a high probability I'm not going to get stopped out. And if I do, I will have wanted to get stopped out because it's probably going lower, right? And meanwhile, I'm looking, can I make 1%? Well, 1% is really not. I did it with WMB, so it's not in there anymore. But that's how I think about it. More math to come, however.
Perfect.
Okay, good. Any parting words of wisdom? Nice haircut, John. That looks good. That's a tight. I'm following you. I've gone that way too. Yeah, looks good.
Thanks. I think my person cutting my hair was watching the Wimbledon finals, and so I got the Djokovic cut.
Hey, the Djokovic cut is a good cut. Yeah, but the Alcaraz cut apparently is superior.
Yeah, clearly. What do you two market structure geniuses think about the current dynamics going on? This is nothing I've ever seen before in terms of, I don't know, what was it, a 12% Russell move or something like that? I mean, is this an unwind? I mean, I've never seen, I was going to send you guys this morning, but the top 13 stocks demand was down, rate of change was 8.5%, and the other 490 was up 7.5. So they're both over their standard deviation for the year, which was, I don't know. This is a strange market to me.
It's extremely rare, right?
It really is.
I think it, I don't know. We're your joke aside, we are not geniuses. We are pretty good mathematicians and we are veterans at what we do. But, You know, what can the only thing I can say is, what is the context? Well, derivatives are renewing. And I think it reflects two things. There's the enormous use of leveraged instruments now. And those leveraged instruments are backed by swaps with big banks. And what do the banks do to offload their swap risk? They use derivatives. All right, so those baskets are renewing, and that's one thing. And number two, there isn't enough liquidity in the market to accommodate money, and it is forced to use alternatives like ETFs and derivatives. They're very similar. And I think we're reaching an inflection point in that. I've always said it would happen at some point. I don't know if this is it, but I think that those things are the issue. Derivatives stretch and warp markets. And when there are significant adjustments to them, the bottom can fall out or things can take off. I think that that's what it is.
Yeah, something doesn't feel right.
I agree.
That's what I think. Like, I love the data, but if you look at the broad sentiment data, it's up, in the last 3 or 4 days. I mean, that's a good run, but the disconnect between, the S&P today, right? Like, how often do we get over 1% or over a typical volatility range when the data's like that is rare, right?
Very rare.
Right.
Yeah. And it tends to produce a reset. And that reset tends to come in the following month. Doesn't always happen, but we'll find out. Yeah. Okay, we kept you long.
We're falling like a lead brick right now.
I know. The Nasdaq's now down 225 points. And the Dow is giving up everything that it got out of that, brief low volatility boost.